Hello, and welcome to the Invest with Carl podcast. This podcast will bring you obviously everything about Carl Investments, discussions about new features and strategies being launched, as well as commentary on general alternative investments news, slanting towards quantitative perspectives and the general democratization of sophisticated investments. Or said simply, bringing high-quality, sophisticated investments to all investors. We're looking forward to the conversation, so let's get started. I'm Jamie Uppenberg, your host today and a member of the Carl team. We're chatting with Alex Shea, a Carl advisor who manages the initial reviews of any prospective quantitative hedge funds who want to be included on the Carl platform. We're going to find out how Carl helps regular investors traverse the complicated world of hedge funds, what Alex looks for in prospective funds, and how he gets Gunnar to actually approve one. I heard it's a little tough. So Alex has a background in banking and portfolio management, while he spent a portion of his career evaluating and allocating to quant hedge fund managers. He's worked with these guys. He's a CFA charter holder. So Alex, welcome to Invest with Carl.
Hi, Jamie. It's good to be here. Thank you.
Good to have you. Let's start here. We are starting with a statistic, actually. In 2020, Gunnar, in coordination with Aon, Carl's due diligence partners, Aon, reviewed more than 400 quantitative strategies, while less than 5% are cleared to be Carl funds. So we always start off with what we think is the driving question of the day, which today is, why did less than 5% of the funds reviewed in 2020 make it to the platform?
Well, that's a great question, Jamie. We always have the end user and investor in mind. And while capital appreciation through diversification is always the end goal for accessing our platform, we believe that user experience and user interaction is another core tenet here at Carl. And how that really translates down to the bottom line is that we're not a listing service. Not any quant manager can just come to us, knock on our door and say, hey, I want to be on your platform. No, there's a rigorous culling and process that we look to. And so you won't find the entire quant hedge fund universe on our platform. And so by curating, we put them all through the ringer and cull that list down to the best 20 to 30 managers that are diversified across many different strategy mixes that we can wholeheartedly feel that we've done the best job putting the best foot forward and giving them the best return profile for them, for our end user. And this really comes down to, and this is in contrast to, for example, you go to Fidelity Mutual Fund Screener and you put in, hey, I want this market cap, I want this style, and you put in four other factors, and you still have a list of 500 different funds. That's still an overwhelming list. For us, we do most of the heavy lifting so that the end investor can actually have time to drill down, learn more about each manager, and we do that pre-screening for them.
Okay, so I hear you. We're pretty hard on our funds in general because of this pre-screening process. And we're hard on our funds in order to help our investors have a clear selection. The selection that we provide is all of considerable quality. If that's what, you don't have 500 and you still have to figure it out. It's like you have 20 or 30 and they're all a reasonably good choice. They're just different investment mixes, right? Different diversification options. So why is that important to do overall and for our Carl investors to know that we're doing it? I get why we're doing it, want to make sure you don't have to, do a bunch of drilling, but what does it mean for us as Carl?
Well, I would say, the old adage, trust takes years to build, seconds to break, and forever to repair. That 100% rings true here. As long as we at Carl continue to strive to do right by the investor, our investors will continue to remain and remain loyal with us. And we feel that the optimal way to build that and build and maintain that trust is to bring the best quality product to market that we can fully stand by, that we personally invest in, that we personally feel that this is the best representation of Carl. And that process looks like culling managers from a risk management standpoint, investment processy, looking at their market mixes, what they like to invest in, what we deem is, illiquid stuff or just completely esoteric markets that we don't think any of our investors should be getting into. But those are just a few of the factors that we rigorously evaluate for each underlying manager. Assessing a hedge fund it's pretty tough. There are a lot of factors, and to be honest, it's not reasonable for an average investor to be able to do all of that on his or her own.
Right, because the funds, some of it's proprietary. There's a lot of digging in. Some of it's, regular investors, they can't even get as deep as we can get.
Exactly. And they won't even get the light of day either, or the airtime with the managers.
Right. They wouldn't even get as deep as we're allowed. So I will ask the question before we go back to what we're really reviewing then. I know from conversations with Gunnar, our Carl CEO, that he is quite tough on the funds. What does it take to get him to approve?
Well, usually $100 bill doesn't hurt, but bad joke. We don't do that. I'm just kidding. For the most part, we're very, very number and data driven. And so if there's a good diversification factor from our other existing managers and diversification benefit relative to regular, let's call it equity and fixed income markets, then that is a very, very good starting point to getting them an external manager their foot in the door.
Okay, so Gunnar is really about making sure they don't correlate to regular markets. Otherwise,
exactly,
you just invest in a regular market. Yeah.
I know
there are other factors as well, but okay. Yeah. So, I heard you talk about when we're reviewing the funds, you've got risk management, investment process, the investment mix, what they're investing in. Then what's the hardest part of the due diligence process? Is there any one place that strategies tend to fall short? Because there's a ton of hedge funds, and we talk about all the time that they are not all amazing. Just because something is a hedge fund doesn't make it, automatically perform amazingly. You really have to find the good ones. So where do they usually fall short?
I think historically, having reviewed hundreds and hundreds of different managers over my lifetime, it's being able to correctly disambiguate good returns from a good research and development process. So another way to put that is our belief is that a good R&D process will always lead to good returns in due time, but good returns are not always reflective of a good R&D process. So another way to think about
what's an R&D process in this case?
So research and development, we always like to see our managers innovating to find new alpha sources to generate new returns. Because just because you find an alpha source that is working today doesn't mean it'll work tomorrow or the next year. Because I think through technology, it's always there's something called alpha decay, which it's capitalism, where if you're making money and it's working, other people will want in as well. Whether it's, you do a great job at a hedge fund and then you have employees leave and set up their own shops. They still, although the intellectual property might be the original firm's, the employee could still be using elements of that and implementing it into their strategy. So that's just one example of human capital departing an existing firm that discovered a new alpha source. So always innovating is good, and making, if applicable, making tweaks and constantly testing out their models to see if they work, because models break all the time and new models work all the time, but you have to know if it's luck or if it just happens to work or there's something explainable behind that. When we look at a manager, it's easy to, when we look at a manager that's actually outperformed their peers in a given year, it's just easy to see if their outperformance is attributable to truly uncorrelated decisions, or if their systems are just jumping into a crowded trade. So maybe 1 year long S&P 500 just worked for everybody and would have worked last year in 2020.
Right.
So if everyone else is, how'd you make your money this year? How'd you make your 25%? Well, 20% of that is attributed to long S&Ps. I would say that manager, for whatever reason, for the most part, is one, correlated to the S&P markets, and number two, do they really have an uncorrelated R&D process that leads to diversification benefits and good solid returns? I'd argue no in that case. So our strong belief is that good R&D will always produce good returns in due time, as long as they're constantly innovating and pouring resources and time into that. Again, I'd like to emphasize in due time, because many times even if you have a strong conviction about shorting markets in 2008, 2007, but you're a year early, you're still wrong. You have the right thought process, but if you get the timing wrong, you're wrong. And so when I say in due time, I just encourage everyone, hey, patience in our managers, patience in having the returns come, because if the R&D is there, the returns will come. And for all our managers, we strongly believe that that's there, and that's part of our very rigorous vetting process.
Great. That's really helpful to understand. I haven't heard that before through our Carl process. So that was great for me to learn. So it's very particular about the type of funds we're looking for, and then the due diligence we take them through. And we're actually going to have more due diligence conversations. I think the risk part of quantitative hedge funds that's actually what makes them interesting, I think, a lot of the time. So I don't go off on that tangent here, because I am very interested. But what do you think all of this means for quantitative hedge funds going forward? I mean, there's big changes here, right? You're vetting funds ahead of time, not for an institution, not for a family office, but for, me and regular investors.
Well, I think this is more of a general macro call. So let me just preface by saying this is my opinion. But personally, being an industry insider, I am a true believer that if anything is automatable, then it's at a severe risk of disruption by a quant hedge fund. So, for example, I had spoken to one manager many years ago, and they actually purchased data from satellites that would take pictures and give constant data feeds to a number of cars in a parking lot, because they managed them. They invested in a long short equity of a retail sector. And so they would track foot traffic, and that would be one of their data inputs. That is something, if someone were to do it manually by hand, and I think probably people have done that, stand on a street corner, but obviously you can't do it all over the country simultaneously, but people have done that before. That's automatable. And anything that's automatable is at risk for severe disruption. Truly segmented and siloed markets, such as real estate, are, in my opinion, at less risk of disruption. But liquid markets that are, you can get data more easily, that's the quant hedge fund's next frontier. I actually was a institutional fixed income trader for several years, and one of the things that I found was we get quotes, probably we call levels or runs, 2 to 3 times a day, and that's, talk about as static as it comes, versus equity markets, you get live pricing by the nanosecond, and fixed income is nowhere near equity markets. But with fixed income, there's a long way to go in terms of getting up to par with there, but they're potentially, prey for quant hedge funds as well. So some things to keep in mind. I think quant hedge funds, because of machines, it's for better or for worse, here come the machines.
Yeah. And for more investors, I think that's really part of the story, is that we're even digitizing so that we can access more investors as well.
Exactly. Gives us the scale.
Yeah, the accessibility for all of us. How would you describe the strategies Carl has available now, and how would you use them in your own portfolio?
So right now, Jamie, we have 4 strategies that are live. It's currently mid-February. The first one is a tail hedging strategy. The second is a long bias technology manager that trades only Russell 2000 stocks. The third is a commodities only manager that trades natural resource products. And the fourth is a long short equity strategy. Again, if you're an investor, you make over $200K a year, or you got $1 million in assets, looking to, whether it's better your risk controls, looking to invest with great managers, or you're a student of finance, and you just want to increase and expand your investments knowledge base, or if you just like truly unique and compelling strategies and you want to diversify your portfolio, I'd refer you to an article that's online at Wealth Professional. James Burton, he's over at AGF Management, says it's a very prudent choice to allocate about 15 to 20% of your portfolio to alternatives. In this case, quant hedge funds specifically would fall into that classification. Our managers have very low correlations to your standard equity and fixed income portfolio. And they provide not just a robust capital appreciation component, but there is also considerable downside protection, especially when you have your conventional 60-40 portfolio not doing so well.
Right. And again, I really look forward to talking more about that. I think it's part of what people don't yet know, that institutions and the uber wealthy, as we call them, have been using for years. They have so much more risk control than has been available to the rest of us.
Exactly.
So we'll have a whole risk series on that, because I think it's just part of one of the main parts that make these so valuable. I think 10 to 20% in alternatives is certainly a standard that we hear quite a bit. And then that downside protection, I think, just changes the game. So what's coming down the pike then? If that's where we are, what are we looking forward to as investors with Carl?
Well, very exciting stuff, to be honest. Number one, the low-hanging fruit is we're coming online with Android. That should be end of Q1, early Q2 targeting. Currently, we're only on iOS, but we should be in Google Play soon, and that will, double our footprint, which is very exciting. But I think you're probably asking more what's on the investment-related horizon.
I think that's what people are interested in. Yeah,
exactly. So 3 things. One, we're very excited about managers that have been applying deep learning or machine learning, artificial intelligence to their trading models. And we found that many of their systems tend to be materially different than your classic white shoe quant managers that perhaps don't apply those. And some of them do incorporate, more nascent versions of that. But for the most part, pure play kind of machine learning guys, they do provide an additional strategy or system to trading markets, which is very compelling. Something else that we're also excited about is more on the business side, is a direct to advisor platform that provides all the same capabilities for our individual investors, but for our wealth management professionals. And it would be a web-based version that provides them with the same allocation methods, the same user-friendly experience and ease of use, to be able to allocate to quant hedge fund managers and make it easy for their end users, their high net worth individuals as well, or just their users.
We're looking to make sure the wealth managers, they stay in control of and managing the money, right? That's the critical part for them. Yeah.
Exactly. And a third thing that we're very intrigued, this is more an ideation kind of further down the line, but even applying a machine learning based recommendation engine that would determine an ideal risk allocation for each of the underlying managers that's tailored to each individual user's or investor's risk profile. And so there's an additional, you can call it alpha, to be had based on the ability to allocate well within the 20 to 30 different underlying managers that we do have.
No, that could be interesting, because so many different diverse funds available, and then trying to court them even further to their particular investor types.
Exactly.
Yeah, could be interesting. Okay, so Alex, it has been great chatting with you, and I know we'll do this again, particularly as we go into the risk series and the operational risk conversations we've had, which I feel very confident you and I are going to have the most entertaining operational risk conversations ever are coming. I can feel it. The operational
is very
risk,
high.
Yeah. Operational risk you never knew was so fun. But I know everyone's excited for that. But for today, what's your final word for our investors?
Final word. How about final words? Innovate or die. I know it's used a lot, but our managers live by that, and we live by that. And the day that we rest on our laurels is the day we sow the seeds of losing the investor's trust. So start building your trust in us. We'll always seek to outperform your expectations.
Thank you. And thank you, Carl investors. And we will see you soon. Thank you, Alex.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.